Spoofing. Spoofing is a lie, and here is how it works. Picture this. You're at an auction trying to buy a painting. You start low. You're the only bidder in the room. Suddenly, 3 people walk in, raise their paddles, and start throwing out huge numbers. You think, whoa, this painting must really be worth something. I need to raise my bid too. So you do. The exact moment you raise, those 3 people turn around and walk out. They never wanted to buy anything. They were there to make you believe there was a demand. So you'd pay more. Spoofing is exactly that, but done on the financial markets by a computer in seconds. Here is the technical version. A spoofer wants to buy a stock at $50. Instead of placing a buy order, they pretend they want to sell, and they flood the market with massive sell orders. 50,000 shares at 50.10, 50.15, 50.20. It looks like someone big is dumping the stock. Other traders see this wall of selling and panic. They sell too. The price drops. At that point, the spoofer cancels all the fake orders, buys at lower price, and disappears. The whole thing takes seconds. Navinder Sarao, a trader operating literally out of his parents' house in West London, ran this scheme for nearly 5 years on the US markets. The Department of Justice charged him in 2015, claiming his spoofing contributed to what known as the flash crash of May 6, 2010. A sudden plunge that in minutes wiped out nearly $1 trillion in market value. $1 trillion. Sarao was sentenced to 1 year of home detention. Since spoofing was made explicitly illegal, US regulators have handed out over $2 billion in fines for it. But here is the uncomfortable truth. Spoofing is still happening. Exchanges try to catch it, but the smarter spoofers spread their fake orders across multiple venues and time their cancellation to stay just below the detection threshold. You can't see a spoofer. You can only see the price moving in ways that don't make sense with no real reason behind them. Spoofing doesn't steal your money directly. It steals the information your decisions are based on. And that's worse. And if right now you already thinking, okay, but how do I protect myself from this? Keep that question in mind, because at the end of the video, I'll point you to a resource that shows you exactly how to spot these manipulations while they're happening. Let's keep going. Layering. Layering is the same trick as spoofing, but done with patience. Imagine walking in a bike shop. While you're browsing, the salesperson quietly sticks sold tags on 20 different models, one by one. You see all those tags and think, damn, bikes are flying out of here. I better grab one before they all gone. So you pay full price for the one you like. What you don't know is that those tags were fake, stuck there specifically to make you rush. As soon as you leave, the salesperson peels them all off. On the markets, layering works the same way. The traders place 20 separate sell orders stacked at slightly different price levels. Taken individually, none of them look unusual. Together, they paint a picture of relentless selling pressure. Automated trading system scanning the order book see this consistent pattern and decide the price is about to drop. So they make it drop. And once it does, the person who built the fake wall buys at the bottom and cancels everything. In 2014, the SEC, that's the US market regulator, the agency that policies Wall Street, charged a firm called Adani Capital Research for using an algorithm nicknamed Gravy that does exactly this in the final seconds of the trading day to move closing prices. Adani paid $1 million to settle. I find that compared to the profit the algorithm generated, most people in the industry consider it laughable. Layering exploits a huge weakness in the modern markets. The fact that anyone watching the screen assumes the orders they see are real. They are not always. And the traders who get hurt the most are the ones who trust the order book the most. If you ever started a level 2 data on a trading platform thinking you were reading the market intentions, you were actually reading a story someone else wrote for you. Wash trading. Wash trading is the simplest manipulation there is. You buy from yourself. You know those restaurants that, when they first open, pay their friends and family to sit at the tables and pretend to eat? It's called fake crowding. And the goal is to make people walking by think the place is a hit. You pass by, see all the seats taken, and think, this place must be great. Let me book a table. Wash trading is exact the same thing, but with a stock. A trader simultaneously places a buy order and a matching sell order. It's basically the same person trading with themselves. No real exchange happens. It's a trader applauding themselves in an empty theater. But on the charts, to everyone else, it looks like traffic activity interest. The point is to inflate volume numbers. Other traders see lot of action and assume there's real interest. Volume-driven algorithms wake up and start buying. Retail traders scanning for stocks on the move get pulled in. At that point, the person running the scheme dumps their real position into the manufactured demand and walks away with the profit. Wash trading has been illegal since 1936, almost a century, which makes it one of the oldest banned tricks in the market history. It has exploded in crypto. A 2022 study by the National Bureau of Economic Research estimated that over 70% of trading volume on unregulated crypto exchanges was wash trading. 7 out of 10. Even Binance, the world's largest crypto exchange, has faced investigation of this. In traditional markets, exchanges catch wash traders by matching account information. If the buyer and the seller turn out to be the same person, alarm bells go off. But the routing through multiple brokers and shell companies, wash trading still slips through, especially on less traded stocks. It creates an illusion the market mistakes for reality. And your charting software can't tell the difference between a million shares of a real interest and a million shares of someone playing with their own shadow. Front running. Front running is simple. It's someone getting ahead of you using information they should have. Imagine you work at a real estate agency. A wealthy client tells you, buy me 50 apartments on the main street. Before you start buying for him, you quickly buy 5 for yourself. Then you start the client's order. Prices go up, of course they do. You just pulled 50 apartments off the market. At that point, you resell your 5 to the client himself at a higher price. He has no idea. You made money at his expense using nothing but the information he trusted you with. On the markets, front running works the same way. A broker receives a massive client order, say 200,000 shares. Before executing it, buys 5,000 for their own account. When the client's order pushes the price up, the broker sells for a guaranteed profit. It's unambiguously illegal, and when it gets caught, it ends in court. But modern front running is way more subtle and way more legal than the textbook version. The firms that trade at extreme speeds, known as HFT, high frequency trading, don't actually see your broker's order directly. What they do is read the signals. When a big institutional fund starts buying, they don't do it all at once. They split the orders in tiny chunks to avoid pushing the price up. But those chunks leave a trail. HFT firms spot the trail, figure out a big order is coming, race ahead to buy first, and resell to the fund at a higher price. This is called latency arbitrage, and it's basically legal. A 2022 study published on the Quarterly Journal of Economics estimates that cost investors around $5 billion per year globally. On the UX exchange, IEX, founded specifically to fight it. They installed a physical speed bump, a 350 microsecond delay made from a coil of fiber optical cable to stop the fast machines from overtaking everyone else. And it worked. Front running has transformed. From a crime committed by corrupt brokers, it's become a structural feature of modern markets that extracts billions from ordinary investors every year. And most of it perfectly legal. Now, there's a way to trade without exposing your own capital to any of this, and that's the trading with prop firms' capital. You only risk the entry fee, just a few dollars, and they hand you 50, 100, even $200,000 to manage. If you lose, you only lose the fee, so a few bucks. But if you win, you keep the profits. In the description below, I've left the prop firm I personally work with, the legit one, not the scammy ones floating around. And I'll leave you even a coupon code to have till 50% off on the entry fee. Let's keep going because now comes the most toxic part. Pump and dump. The pump and dump is the oldest scam in the market. And it works the way every scam works. They sell you a dream, you pay top dollar, and then you find out it was a bubble. Think about those ads for miracle products that show up every time for 2 weeks, generate mass hysteria, send sales through the roof, and then disappear, leaving thousands of people with a drawer full of useless junk. The pump and dump is the financial version of that. It works in 2 phases. The pump, the inflation. Someone creates artificial demand for a stock through exaggerated claims, coordinated buying, social media campaigns, paid articles. The dump, the unloading. Insiders sell everything, while the outsiders are still buying, convinced they found the deal of the century. When the pump ends, the price collapses. Whoever showed up last is left holding the bag. In the early 2000s, pump and dumps ran through penny stock newsletters and email spam. The SEC shut down hundreds of these operations, but the social media arrived and everything changed. The meme stock phenomenon of 2021, when millions of retail traders coordinated on Reddit to buy stocks like GameStop, blurred the lines between organic enthusiasm and organized manipulation. The SEC investigated whether the influencer pushing stocks on Reddit and Twitter were running a new kind of pump and dump. No charges were filed, but the final report acknowledged that the mechanism was functionally identical to traditional pumps. In crypto, pump and dump operate in broad daylight. There are Telegram groups with hundreds of thousands of members coordinating to buy obscure token all at once, inflate the price by 500%, 2000% in minutes, and then dump everything on the latecomers. A 2018 Imperial College London study identified 4,818 pump and dump schemes on the crypto exchanges over just 6 months, almost 1,000. The pump and dump works because it exploits the gap between what you see, price raising, volume exploding, and what you don't see, which is the reason behind it. Manipulation through dark pools. Dark pools are secret markets, literally. Imagine going to the fish market in your city. The one you can see, the one where you buy, quotes you a price. But you find out that the 40% of the real fish, the good stuff, gets sold in a back room nobody can enter except wholesalers. Prices you'll never see. You buy what's in front of you, and they tell you the price is fair. Fair based on what? If half the market hidden from you. Dark pools are exactly that. Private trading venues where big institutional investors, banks, pension funds, hedge funds, buy and sell stocks without the trades being visible to the public. The original justification was legitimate. If a fund needs to sell 1 million shares, showing that order in the open market would crash the price before they could even execute it. So they sell in the dark. That makes sense. The problem is that the dark pool have also become places where manipulation happen. In 2016, the SEC fined two banking giants, Barclays and Credit Suisse, a combined $154 million. What had they done? Barclays was telling its institutional clients that its dark pool was a safe place, protected from predatory high-frequency traders. In reality, it was letting those exact traders into the pool, allowing them to trade against the very clients who thought they were safe. Credit Suisse, on the other hand, had lied about how it handled certain order types, hurting clients who believed they were getting the best possible execution. Dark pool manipulation is insidious because it's invisible. You can't see the trades until after they have already happened. You can see who's in the pool. You can see how they are trading against you. Official data shows that dark pools regularly handle over 40% of all US stock trading. That means nearly half of all stock trading worldwide happens in hidden rooms where you can't see the price. You don't know who's on the other side, and you can't verify that the price you got was honest. Dark pool manipulation doesn't steal your money directly through a rigged price. It steals your right to know who you're trading against and whether the venue you're using is working for you or against you. Bear raid. A bear raid is a coordinated attack. Imagine a group of people decide to destroy the reputation of a restaurant. They leave negative reviews everywhere, spread the rumor that customers got sick eating there, write articles hinting the place is about to shut down, and within weeks, the restaurant is empty. The owner is in trouble. The value of the business has collapsed. At that point, those same people show up and buy the restaurant for a quarter of its real price. On the markets, the same thing happens, but with a stock instead of a restaurant, and with massive profits instead of a single location. Technically, in a bear raid, a group of investors bet against a stock. They borrow shares, sell them, and hope to buy them back cheaper to return them and pocket the difference. That's called short selling, and it's legal. What's illegal is coordinating to force the price down, spreading negative stories, and putting pressure on shareholders until they panic sell. Bear raids have a long tradition on Wall Street. During the 1929 crash, the legendary speculator Jesse Livermore was accused of orchestrating bear raids on multiple stocks, though he always denied it. In 2008, in the middle of the financial crisis, the SEC temporarily banned short selling on 799 financial stocks, accusing hedge funds of running raids on the banks. The ban was controversial. A 2012 study showed that, paradoxically, it had increased volatility and made things worse for the very stocks it was trying to protect. Modern bear raids look different. They are no longer a group of traders in smoke-filled rooms. They operate through published research reports, social media statements, detailed theses backed by charts and data. In January 2023, an American research firm called Hindenburg Research released a damning report on India's Adani group, accusing it of a major financial irregularities. The result, over $100 billion in market value wiped out in days. The largest single event destruction of wealth ever caused by a research report. Whether it was a legitimate expose or a sophisticated bear raid depends entirely on how true the accusations were. Bear raids exploit the asymmetry between building value and destroying confidence. It takes years to build a company's reputation and a few hours to bring it down. Cornering the market. Cornering the market means taking it all. Imagine you decide to buy all the coffee in the world, all of it. At that point, anyone on earth wants a cappuccino has to go through you. You set the price. The word pays. Sound like a brilliant plan every time it ends in disaster. Even for the person trying to pull it off. Technically, cornering means accumulating such a dominant position in an asset that you control the supply. It's the ultimate form of manipulation, and it's almost always catastrophic for everyone involved, including the person attempting it. The most famous corner in the history belongs to the Hunt brothers, Nelson Bunker and William Herbert, two Texas oil tycoons who decided between 1979 and 1980 to buy up all the silver in the world. They accumulated roughly 1/3 of the global silver supply. Prices shot from $6 an ounce to nearly $50, a 700% increase in just a few months. For a moment, it looked like they were winning. Then the exchanges, watching the system go haywire, changed the rules mid-game. They raised the margin requirements for anyone betting on silver, forcing the Hunts to sell. Prices crashed. The Hunts lost $1.7 billion and eventually filed for bankruptcy. A more recent case you probably know is GameStop in 2021. Even though it wasn't planned as a corner, had the same effect. Millions of retail traders coordinating on Reddit refused to sell shares of a struggling American video game retailer. The problem was that several hedge funds had bet against GameStop for an amount larger than the actual number of shares that existed. A paradoxical situation known as a short squeeze. To close their bets, they had to buy shares nobody was willing to sell them. The price exploded. One of those hedge funds, Melvin Capital, lost $6.8 billion and shut down the following year. Cornering works in theory because supply and demand are real, but in practice, the exchanges and regulators will change the rules mid-game to prevent systemic damage. The Hunts learned this. Melvin Capital learned this. The lesson is always the same. You can dominate a market, but you can't dominate the institution that runs it. The house always protects itself first, and everyone else becomes collateral damage in the correction. You just saw 8 ways the market is rigged against you. The good news is every one of these tactics leaves visible traces if you know what to look for. In my free trading academy, I show you how the market actually moves on the same charts you've already looking at every day. The link is in the description, and if this video was useful, drop a like and subscribe to the channel. Helps the channel and tells me to make more like this one. See you in the next one.